For what feels like an eternity, the investment world has been utterly captivated by a particular constellation of stars, the Magnificent Seven: Apple, Microsoft, Amazon, Alphabet, Nvidia, Tesla, and Meta. Their dazzling performance has, for a long while, been the singular story. They were the main act. But what if I told you that beneath the surface, a truly remarkable shift has been quietly unfolding? We are seeing a seismic rumble, not from the usual suspects, but from a silent majority of companies. Imagine the often ignored Russell 2000 index, a diverse basket of smaller American companies. This index is not just outperforming the mighty S&P 500 for a day, or even a week, but for an unprecedented string of consecutive trading days. This is a historical streak. It is a signal so clear and resonant that it demands our immediate attention. It is not just the small caps shouting from the rooftops. Look closer at the S&P 500 Equal Weight Index. Here, every company, from the tech titans to the industrial stalwarts, carries the same weight. What has this equally weighted barometer been doing? It is hitting record highs. This whispers, no, it roars, that the market's rally is no longer just about a handful of glittering giants. It is broadening. It is deepening. It is finally showing signs of robust, widespread participation. This is more than just an interesting data point for market historians. This is a profound question mark hanging over the narrative we have all internalized. Is the market's rally finally, unequivocally, moving beyond the Magnificent Seven? More importantly, what does this monumental shift mean for your portfolio? If you have been leaning heavily on those tech giants, you might just be missing the very next wave of opportunity. This wave is not just bigger, but broader, and perhaps more sustainable for the diverse economic landscape of 2026. So if this is not just a fleeting anomaly, what is truly driving this quiet revolution? The answer, in a word, is rotation. We are witnessing a clear, undeniable rotation in market leadership. This dynamic dance is driven by a fundamental reevaluation of future earnings growth. For years, the story was simple. Mega cap tech was where the innovation was, where the growth resided. However, diligent analysts, those who pore over balance sheets and forward-looking statements, are signaling a compelling new narrative. Their projections for the coming years, specifically 2024 through 2026, indicate an acceleration in earnings for the S&P 400, our mid-cap darlings, and perhaps even more notably for the S&P 600, the small-cap champions. Crucially, these projections suggest that this growth for the mid and small caps will not just be robust. It could very well surpass the growth rates we are anticipating from the mega-cap tech sector. A crucial shadow also looms large over the entire financial landscape: the Federal Reserve. The anticipation of potential Federal Reserve rate cuts later in the year is creating a vastly more favorable environment for smaller, more rate-sensitive companies. These cuts could begin as early as the first or second quarter of 2026. Smaller businesses, by their very nature, often rely more heavily on borrowing. When the cost of borrowing starts to ease, even incrementally, it is like a shot of adrenaline to these companies. Their debt burdens become more manageable, their access to capital improves, and their ability to invest in their own futures skyrockets. The economic narrative, however, is not solely dictated by central bankers. There is another, often more unpredictable force at play: politics. New political and regulatory pressures are looming large on the horizon. They are beginning to impact specific sectors. This adds yet another layer of complexity and indeed opportunity to the market dynamics of 2026. These are not just abstract threats. They translate into tangible risks and rewards for companies operating in those crosshairs. What we are observing is a multifaceted transformation, a recalibration of growth expectations influenced by a potentially more accommodative monetary policy from the Federal Reserve, further complicated by the ever-present, sometimes volatile, hand of political and regulatory scrutiny. This confluence of factors is setting the stage for a market environment in 2026 that promises to be far more nuanced and diverse, and potentially more rewarding for those willing to look beyond the usual suspects. This is where the real mechanics of the market come into play, showing us exactly how these shifts are manifesting. The Russell 2000, that benchmark for small cap US companies, has done something truly remarkable. It has outperformed the S&P 500 for 9 consecutive trading days. Let me repeat that. 9 straight days. This is not just a statistical blip. It is a historical rarity, a feat last observed in the early 1990s. This dominance signals robust underlying market participation, telling us that investors are not just piling into the same few large, well-known names. Instead, capital is flowing into a much broader array of companies, suggesting a healthier, more sustainable rally. To further reinforce this broadening rally, consider the S&P 500 Equal Weight Index, often referred to by its ticker RSP. Unlike the traditional S&P 500, where companies are weighted by their market capitalization, the Equal Weight Index gives every single company the exact same influence. What has this equally weighted barometer been doing? It is hitting record highs. This is a powerful signal. It means that the strength we are seeing is not just an illusion created by the continued ascent of a few mega-cap tech stocks. Instead, gains are broadly distributed across sectors and companies. This broad-based strength is inextricably linked to clear sector rotation. While tech and consumer discretionary, the traditional high flyers, are currently taking a breather, we are witnessing a resurgence in sectors that thrive in different economic environments. Energy, for example, is showing renewed strength year to date. Materials companies, those that provide the building blocks for our economy, like chemicals, metals, and mining, are also seeing significant tailwinds. Then there are the industrials, a broad and vital sector. Within industrials, we are seeing particular strength in areas like defense, propelled by global instability, and heavy equipment manufacturers like Caterpillar, a clear indicator of anticipated infrastructure projects and global industrial expansion. This rotation is a classic sign of investors moving away from pure growth plays towards more cyclical, value-oriented sectors. Now, let us pivot from the market's internal mechanics to an external force that is increasingly shaping sector performance: politics. Nowhere is this more evident than in the financial sector, specifically banking. President Donald Trump has recently focused on consumer affordability, making it a key plank of his economic platform. A major target includes credit card swipe fees and interest rate caps. We are talking about the Credit Card Competition Act. This legislation aims to reduce the fees merchants pay to banks for processing credit card transactions and could potentially put limits on the interest rates banks can charge consumers. However, Wall Street is pushing back forcefully. JP Morgan, one of the nation's largest banks, has been particularly vocal in its opposition. Their argument is that such caps and fee reductions could lead to a worst-case scenario for consumers and the broader economy. They contend that if banks lose significant revenue from swipe fees, they will inevitably find ways to recoup that income. This could manifest as reduced credit access for lower-income individuals or increased fees elsewhere, for example, on checking accounts. The market fallout from these regulatory threats has been immediate and stark. Major payment processors like Visa saw their stock prices drop by 4 to 5% on the news. Even large banks like JP Morgan, despite reporting strong earnings, experienced an 8 to 9% intraday drop. This illustrates the extreme sensitivity of these companies to regulatory pressures. This political undercurrent creates a significant risk factor, transforming what might otherwise be a stable sector into a potential minefield for investors. Compounding these political pressures is the ongoing dance between inflation, employment, and the Federal Reserve's perennial dilemma. Let us look at the latest Consumer Price Index, or CPI, a crucial gauge of inflation. The headline CPI came in at 2.7%, aligning with expectations. The core CPI, which strips out volatile food and energy prices, registered at 2.6%, slightly below expectations. On the surface, these numbers seem to indicate that inflation is moderating towards the Fed's 2% target. However, digging deeper reveals complexities. Food prices, for instance, saw their highest rise since January 2023. On the other hand, housing costs, a sticky component of inflation, appear to be stabilizing. These conflicting signals make the Fed's job incredibly difficult. Indeed, we have contrasting views on the path forward for interest rates. President Donald Trump has been an aggressive advocate for immediate rate cuts, arguing that the current rates are stifling economic growth. The Fed, on the other hand, maintains a cautious stance. Their primary mandate is a dual one: achieving maximum employment and maintaining price stability. While inflation is trending down, they remain focused on the employment market, which continues to show resilience. They are also wary of potential seasonal price increases in early 2026 that could reignite inflationary pressures. Adding another prominent voice to this debate is BlackRock. A former Fed official from BlackRock has been advocating for quicker rate cuts. Their argument stems from a perceived instability in the employment market. They suggest that while headline unemployment numbers might look good, underlying cracks could be forming. They emphasize the risk of significant economic damage if the Fed delays, pointing to historical precedents where central banks waited too long to ease monetary policy. The stakes are incredibly high, as the Fed's decisions will directly impact everything from mortgage rates to corporate borrowing costs. Finally, let us turn our attention to the behemoth of modern innovation, artificial intelligence. Its footprint is expanding rapidly, reaching far beyond the obvious chip makers. At the core, of course, are the semiconductors. Companies like TSMC, Taiwan's semiconductor manufacturing company, are at the epicenter of this revolution. TSMC operates with what it calls a catastrophic investment philosophy, an aggressive and unprecedented capital expenditure plan driven by overwhelming, insatiable demand for AI accelerators from their key clients like Nvidia and AMD. This relentless demand is creating bottlenecks, particularly in high bandwidth memory, or HBM. This supercycle in semiconductor manufacturing naturally creates direct beneficiaries among the equipment suppliers. Companies like ASML, based in the Netherlands, hold a near monopoly on extreme ultraviolet, or EUV, lithography machines, essential for manufacturing the most advanced chips. Applied Materials provides a wide range of equipment for fundamental steps in chip fabrication, and KLA, dominant in process control, ensures quality and yield. These companies are experiencing a, quote, supercycle of demand, fueled by the imperative to build more powerful and efficient AI chips. They are the picks and shovels of the AI gold rush. However, AI's impact is not just confined to the hardware layer. We are now seeing a massive shift towards enterprise AI adoption. CIO surveys from prominent research firms like Bernstein and Morgan Stanley highlight a critical trend. Microsoft, with a 70% increase in enterprise AI spending among its clients, and Amazon, seeing a 42% increase, are dominating this space. Why? Because businesses prefer integrated, managed solutions over trying to build custom AI infrastructure from scratch. These tech giants offer comprehensive cloud platforms with embedded AI capabilities, making it easier and more cost-effective for companies to adopt and scale AI. This brings us to the unconventional AI winners. Take Shopify, for instance. This e-commerce platform has reported 33% revenue growth, driven in part by strategic AI partnerships. They are using AI to help merchants generate ad creatives, write compelling product descriptions, and personalize shopping experiences. This led to a 600% increase in clicks for merchants during the recent holiday season. Then there is ServiceNow, a company focused on digital workflows. They have deployed over 450,000 AI agents, resulting in an estimated $350 million in value creation. Even Royal Caribbean, the cruise line, is benefiting using AI to optimize pricing strategies and personalize marketing campaigns. We cannot overlook Palantir either. Citigroup recently upgraded Palantir, citing its leadership in agentic AI. This refers to AI systems that can reason, plan, and execute actions independently. Palantir's platforms, with their advanced data integration and analysis capabilities, are perfectly positioned to benefit from global geopolitical instability and government defense modernization cycles. These diverse examples powerfully illustrate that AI is no longer just a futuristic concept. It is a present-day catalyst for revenue growth, operational efficiency, and transformative change across a spectrum of industries. These profound shifts have significant implications for how we approach investing in 2026 and beyond. The most crucial takeaway is the call for investors to look beyond the growth at any cost mentality that has often dominated headlines. While mega-cap tech still holds immense value and innovation, the current market dynamics increasingly favor a more diversified approach. The broadening of the rally, driven by mid and small cap outperformance, suggests that relying solely on a handful of tech giants might mean missing out on substantial opportunities emerging across a wider spectrum of the economy. This environment is ripe for unlocking undervalued gems. Investors might actively seek out companies that demonstrate consistent strength beneath the surface. What defines an attractive stock in this new landscape? First, look for companies that have delivered consistent earnings beats, ideally in 7 out of the last 8 quarters. Second, observe how the market reacts. Strong post-earnings outperformance. Third, keep an eye on EPS estimate upgrades from analysts. Critically, ensure that the company's current valuation, specifically its 12-month forward price-to-earnings ratio, is at least 5% below its 5-year average. This last point helps identify quality companies that still have room to grow in valuation. Applying these criteria can reveal a compelling list of smart investment opportunities. Consider companies like Booking Holdings, which continues to deliver strong results in the travel sector. S&P Global, a diversified financial information and analytics firm, benefits from market activity across the board. In healthcare, Doximity, a digital platform for medical professionals, shows consistent growth. For consumer staples, Sprouts Farmers Market has demonstrated resilience. And in medical technology, Dexcom, a leader in continuous glucose monitoring, continues to innovate and expand its market. These examples highlight that opportunity exists in many forms, often in less celebrated but equally impactful sectors. Now, let us turn to the future of financials and the persistent policy risks that could shape the sector's trajectory. The ongoing friction between Wall Street and Washington is not a fleeting phenomenon. It is likely to be a defining characteristic of the coming years. Specifically, the potential for continued political pressure on banks and payment processors creates an environment of inherent volatility for the financial sector. In a best-case scenario, the legislative efforts around credit card swipe fees and interest rate caps could indeed lead to a more affordable financial landscape for consumers. If effective and well implemented, these policies might genuinely reduce everyday costs for households, particularly those with lower incomes. However, the worst-case scenario paints a more challenging picture. As Wall Street argues, stringent regulations could lead to unintended consequences. Banks and payment processors might be forced to cut services, raise other fees, or reduce credit availability, especially impacting subprime borrowers. This could lead to a two-tiered system where those who need credit most find it harder to access. It is crucial to understand that these policy debates are likely to persist beyond the 2026 election cycle. The tension between consumer protection and industry profitability is a perennial one. Any resolutions will likely be iterative and subject to ongoing political shifts. This creates a long-term risk factor for specific financial subsectors, demanding careful consideration from investors about the regulatory environment of the companies they choose to back. Finally, let us explore AI's second wave of opportunity. While the initial investment wave focused heavily on the underlying infrastructure, like the chips, data centers, and foundational models, the next phase is unequivocally centered on enterprise adoption and application. The real, tangible value creation in AI is now shifting to where it can demonstrate quantifiable revenue growth, significant cost savings, and enhanced customer engagement across a vast array of industries. The power of AI to transform even quote-unquote mundane tasks is immense and often overlooked. Royal Caribbean is not just talking about AI. They are using it to optimize cruise pricing and marketing strategies.
Shopify is not just a platform. Its AI partnerships are generating ad creatives and product descriptions that lead to a 600% increase in clicks for its merchants. ServiceNow is leveraging AI to deploy hundreds of thousands of intelligent agents that automate customer support and streamline complex workflows, translating into hundreds of millions of dollars in value creation.
These are not futuristic hypotheticals. These are real-world, demonstrable impacts on core business operations. Therefore, identifying the real AI winners in this second wave requires a keen eye for companies that can quantifiably demonstrate AI's impact on their financials. It is no longer enough for a company to simply mention AI in an earnings call. Investors should look for concrete examples of how AI is driving revenue, cutting costs, improving efficiency, or creating entirely new product lines. The focus should be on practical application and measurable results, rather than just the hype surrounding the technology. The companies that successfully integrate and leverage AI to solve real-world problems will be the true beneficiaries of this next phase of the AI revolution. In summary, 2026 is shaping up to be a profoundly more nuanced market than the one we have become accustomed to. We are witnessing a broadening market rally, moving beyond the concentrated gains of a few megacaps to embrace a wider array of companies, particularly in the mid and small cap segments. Simultaneously, significant political and regulatory risks continue to loom over the financial sector, creating volatility and complex trade-offs. Throughout it all, AI's pervasive impact is expanding, moving beyond the initial infrastructure build-out to drive tangible, quantifiable results across a diverse range of industries. The key takeaway for every investor is simple yet powerful. Adapt and diversify. The market of 2026 demands a flexible and informed approach. Investors must adapt to a market that is increasingly diverse, influenced by dynamic policy changes, and recognizing that AI is transforming a wider array of industries in tangible ways. Remaining too narrowly focused on past winners risks missing the next wave of opportunity. Therefore, we encourage all viewers to stay informed. Keep a vigilant eye on the upcoming first and second quarter earnings reports. These will provide critical insights into real-world performance. Pay close attention to Federal Reserve commentary. Any shifts in their stance on interest rates will ripple through the entire economy. And do not underestimate the ongoing policy debates in Washington. These political undercurrents will continue to reshape specific sectors and create both risks and opportunities. The investment landscape is shifting. Those who are prepared to adapt and diversify will be best positioned to unlock the opportunities that lie beyond the Magnificent Seven.